Traditional wisdom suggests keeping options open, but in venture capital and crypto markets, that optionality often acts as a structural drain on long-term performance. Y Combinator data on the idea fog reveals that founders who juggle multiple projects to hedge their bets generate highly flawed data. They dilute their focus and kill viable concepts because they never commit enough energy to see what actually works. This trap is currently flushing intermediate players out of the digital asset space. Attempting to lightly sample the market without a core thesis creates a vulnerability that macro conditions are now aggressively exploiting. Look at Bitcoin's dormant supply. Right now, over 70% of the total network supply is held by entities refusing to sell. They are operating in direct opposition to market consensus by explicitly eliminating their own liquidity. Whether you are an AI founder or a whale accumulator, true dominance requires a deliberate decision to foreclose your other options and commit to a single vector. Mimetic behavior is the human default. We tend to want what we want simply because the people around us want it, driven by the constant pressure of social proof. The anti-mimetic edge is the rare capacity to act on internal conviction, moving in a direction that generates friction with your peers. It relies on your own data, regardless of popular trends. Warren Buffett exemplified this in the late 1960s. As market speculation reached a fever pitch, he didn't just pivot, he closed his partnership entirely, refusing to participate in the irrational mechanics of the crowd. Today's institutional players show the same psychological framework. While retail sentiment fluctuates with the news cycle, smart money has been accumulating heavy digital infrastructure during periods of peak market fear. This reveals a central paradox of capital. The entities with the lowest levels of diversification are currently capturing the most market share. At Y Combinator, the strategy is to go deep. Founders are instructed to burn their other boats, shutting down side projects and backup plans to focus on one specific problem. By burning their boats, an operator creates a hyper-accurate feedback loop. Total immersion produces a high signal-to-noise ratio, allowing them to iterate based on reality rather than abstract theory. This is a realized cap hodl wave chart, the on-chain equivalent of a burned boat commitment. It tracks the age of every coin. The swelling of older bands represents entities foreclosing their option to sell. As bands thicken, more supply is locked away. This behavior creates an empirical supply shock. By removing liquidity from the market, these holders force all other participants to compete for a dwindling supply of available assets. This conviction stands in contrast to the high churn of short-term holders. These participants map directly to the failing dabblers in the startup world, constantly shifting focus and losing capital to market noise. In chaotic, high-noise environments, sampling every direction produces almost zero useful information. Performance in these sectors is instead driven by concentrated, illiquid commitments that survive market volatility. Deep commitment requires shedding your previous identity. High-level operators often describe the process as wearing a new skin, becoming a version of themselves that is unrecognizable from when they started. Tony Robbins is an extreme example. Born Anthony Mahavarick, he architected a new identity from scratch, designing his discipline and presence to compel an audience. Ralph Lauren did the same. To manifest an adventurous operational reality, he immersed himself in new aesthetics, adopting Western wear to inhabit a specific vision. We see this shift today among legacy finance firms. To remain relevant, they are being forced to recreate themselves as native digital asset infrastructure providers. This transformation is painful and unpopular. It attracts skepticism from peers who remain tethered to the traditional models of the past. Success in this new identity requires extreme precision. Strictly defining your terms and your mission, even if it alienates some, is necessary to create a shared reality for the team executing the vision. Mastering your internal narrative and public image is not a vanity project. It is a prerequisite for executing an anti-mimetic strategy. The AI era has introduced a new macroeconomic reality. The cost of producing and deploying software is rapidly converging to zero. As a result, pure software startups are losing their defensive moats. Traditional SaaS models are becoming increasingly vulnerable to rapid replication and automation. This necessitates verticalization, the ownership of an end-to-end industry outcome, rather than just the software tools used to reach it. Consider Corgi Insurance, a recent Y Combinator startup that illustrates this principle. Corgi refused to settle for being a software vendor. They acquired an insurance carrier to control the entire commercial insurance stack. Controlling underwriting and service allows them to capture the entire economics of the sector, pushing fragmented competitors off the board. When code can be generated instantly, the true assets cannot be automated: regulatory licenses, physical infrastructure, and customer trust. In a world of free software, value accrues to the entities that control the physical or regulatory bottlenecks. This concept of full-stack verticalization applies directly to the mechanics of Bitcoin mining. Digital miners face constant threats from network difficulty adjustments and the margin compression that follows every halving event. Intermediate layers and purely digital mining operators are being squeezed out of profitability. Without a structural advantage, they cannot survive the rising cost of production. This Bitcoin hash ribbons chart shows the result. Downward crossing moving averages signal miner capitulation, purging participants who failed to verticalize. Elite institutional players respond by moving upstream to acquire physical power plants and energy transmission grids. Owning the base power generation layer is the only way to insulate an operation from the collapsing margins of global hash rate competition. This physical energy layer serves as the ultimate structural moat. It is a tangible barrier that provides a permanent advantage over purely digital competitors. The security of a decentralized digital network now relies on the dominance of hyper-centralized, full-stack physical infrastructure. Real anti-memetic behavior is a prerequisite for long-term survival. Committing to ESIS while the crowd seeks safety and diversification is an untouchable form of high status. Mathematician Grigory Perelman demonstrated this total immunity to external validation. After solving one of the world's most difficult geometric problems, he rejected a $1 million prize to go pick mushrooms, indifferent to the consensus of his peers. Palmer Luckey showed a similar focus. He ignored the popular software trends of Silicon Valley to build hard tech in a trailer park, creating the hardware foundation for an entire industry. This strategy remains consistent. Burn boats to eliminate optionality, ignore the memetic crowd to build internal conviction, and ruthlessly acquire physical bottlenecks to own the full stack. On-chain supply illiquidity and mining hash rate stability are real-time indicators of this thesis. Whether you are scaling an AI startup or tracking digital market structures, flawless execution requires absolute, concentrated conviction. Subscribe to Decode Future Market Signals and follow on Twitter to find your own anti-memetic edge.